don't think the market should have been disappointed or surprised at all by Jay Powell's message, which was that, it's incredibly uncertain, our immediate future, rates will stay low for the foreseeable. We all kind of knew that. I sort of view the markets a bit like a petulant child in this case. They just kind of threw their toys out of the stroller because they wanted more, but, more wasn't justified, particularly given that the Fed upgraded a lot of its forecasts. Nor is there a whole lot more that the Fed can do, even in terms of generating demand so that it can hit its inflation targets, or it can exceed 2% so that it can now come up with a 2% average over some undetermined period of time. So I think the markets just wanted more. I don't think that they actually expected more, and that's where the disappointment came from.
Megan, I know you were over here in London this week. What did you make of the difference in what you're seeing between the US response and what's playing out in Europe and in the UK in response to COVID-19?
Well, I'd say that Europe and the UK are quite different, actually. So at the beginning of this crisis, the UK actually had quite a joined-up response between the Treasury Department and the central bank. And so I think the UK started out as a real winner. But since then, particularly given that a lot of the fiscal measures, the furlough program is set to expire now, the UK is starting to look a bit more like the US in terms of actual economic policy, also in terms of virus management with, pretty significant spikes in new cases in the UK now and new measures being reimposed. Europe has also seen a spike in new cases, but I think that the economic policy has been more supportive. So I think the UK is starting to look a bit more like the US in terms of support being withdrawn too early, concerns about the deficit and debt burden at a time when real yields are actually negative, so governments get paid to borrow. It's a no-brainer. The UK is looking more like the US than it is looking like the continent at this point.
I take your point on that, although that said, the discussion around negative rates yesterday made us feel a bit more European as the door is wide open to those negative rates. That's always been one of the concerns, that you've got an ultra-dovish Fed at this point, and where does that leave other central banks like the Bank of England and the ECB? Do you think negative rates are a decent prospect for the UK, or do you think they will ultimately avoid going negative?
So it depends on which rates go negative, I would say. So, if the regular deposit rate is negative, we have evidence from Japan and the Eurozone that that's not particularly effective. If you were to introduce another rate like the TLTROs in the Eurozone, then you're introducing a rate for borrowers that's separate from a rate for depositors, savers. So you can cut the borrowing rate deeply negative, and that's a stimulus for the economy, while not punishing savers and banks by keeping the deposit rate less negative or positive. And the UK has sort of done this a little bit with its term funding scheme, its funding for lending scheme. And so there is precedence for this in the UK, but just cutting the regular deposit rate into negative territory probably won't help. And also, it might come early next year at a time when the UK probably needs international investment, and negative rates will just drive international investors elsewhere. So I think it could be counterproductive. At the very least, it probably won't help much.